Welcome to another episode of Coffee with Kirk. Hope you're doing well. Today, probably not going to surprise you, but we'll talk about what's going on in the markets here the past week. But yesterday was really pretty ugly. But it's been getting ugly for a little while now. So is it just a normal correction? I mean, corrections are kind of a normal process that you like to see every so often, because the more corrections you have, minor corrections, it means you're not going to be facing big downturns. When you go a long time without any kind of normal 10% or 5 to 10% correction, if you don't have many of those, then you basically kind of build up to the point where you end up with a bigger correction, more painful correction. And it's kind of like, forest fires happen if you don't clear the brush, if you don't take care of the forest, if you don't do controlled burns. When you finally end up with a fire, and you're going to end up with a fire, you have an uncontrollable fire. So this could just be a correction, minor correction, but a couple things have me thinking that maybe it could be something bigger than that. And that's what we'll talk about here today. And we've been talking about these topics a little bit for quite some time now. I've been, ever since the yield curve inverted, we've been watching for this, and it's been one of the longest inversions ever. I think, in fact, it might be the longest inversion ever, but it's starting to break that. So yeah, there's some interesting things going on, and let's just jump right in and get going with it. So you can kind of see here the past 2 weeks, we've started to see a topping in the markets overall. And it's, this week was very pronounced. We had a big downturn start of the week. Then we had a big rally. But then we once again had a pretty big drop in the markets. So, but it's been going on. And so far, like I said, this could just be a normal correction. And then, we get a little bit of a breather here, and then up and to the right again, and we start going. So nobody knows for sure. Now in the NASDAQ, it's been a lot more painful than just the S&P 500. We've seen a bigger move down. It's corrected already about 12% from its peak. Now it was going crazy. So, it's had a really good 2-year period for the NASDAQ. And we talked about this, and it's mostly due to just a handful of stocks. And all those handful of stocks have been kind of driven up mostly because of artificial intelligence, or AI. So anything that's really been focused on AI and the market sees as a big player in AI has just gotten to extreme nosebleed valuations. And we've talked about this before. I've talked about it probably to the point where you're sick of hearing about it. But what we're starting to see now, though, is that the markets are starting to look at, okay, what are they spending on AI? And is it actually resulting in more income? And some of these companies that have reported recently, tech companies, the ones that have been the benefactor of the AI price increases in share price, well, they're saying they're spending a lot on AI, but they haven't actually turned in any profits. And I've been saying all along, this feels like, 1999 or early 2000, whereas the internet was clearly going to change the world, just as probably AI will. But so many companies that were talking about having internet capabilities or website capabilities, and what ended up happening is they didn't see the actual profits come from being on the internet. So we had a huge collapse back in 2000. until 2002 of tech stocks. And it didn't mean that the internet was going away. It didn't mean it wasn't going to be an enormous part of our lives, but it just, the market got bid up way past any kind of revenue or earnings that they're going to get in the near term. So at the end of the day, I've talked about this before, when you're an investor, what you're buying is future cash flows. And if you're going to pay exorbitant amounts of money for a stock, then they should be driving these cash flows to you at an accelerated pace. And if they're not, that's when you have problems. So you can see here, Amazon is really taken on the chin. Just Friday, they were down almost 9%, but they're down from about 203, I think is their peak, and now they're down at 167. And that's all within just a 2-week period here, with a lot of it coming the past couple of days. So Amazon has really taken on the chin. One company that hasn't was Apple. Now, Apple, we'll see what happens with them, but I've been saying that of all the, Mag 7 stocks, those handful of tech companies, I think Apple's probably the most overvalued, just because it's not the same company it was 10 or 15 years ago. It's actually valued higher right now than it was during its high growth phases. And Apple's pretty much a mature company now. They're not going to have massive amounts of revenue and earnings growth, but they're kicking off a lot of good earnings and revenues. So it's more of a stable company, and we shouldn't see the volatility that we're seeing or the valuation that we're seeing. So it's going to be interesting to see. I mean, it was actually up a little bit yesterday when everything else was tanking. So we'll see. I can't remember if they've already reported earnings or not, but we'll see when their earnings come out. But Google is another one that has sort of, been waylaid by the fact that they're putting a lot of money into the AI, but they haven't really started to see any results from it yet. This is NVIDIA, again, the darling of AI. And I think they report in a week or two, but the big thing for them, it's just their valuation was so ridiculous. 40 times sales, and then over 100 times earnings. So, that's just not normal. So any little suspicion by the market that, maybe they're a little bit ahead of their skis on this whole AI thing, if they start to get nervous about it, when you have nosebleed valuations and they start to correct and come back to a little bit more of a normal valuation, you're going to see some pretty painful markets. Microsoft as well has kind of taken it. They reported this week and said, again, we put a lot of money into it, haven't really seen any revenue from it yet. Markets aren't liking that. So they got bid up because of the AI, thinking it was going to drive earnings, and so far it hasn't. And, some reasons that it seems like this could be a little bit different, and that's sort of the topic for today, but this is the volatility index. Now, we've had a small position in this, and it's just been a total loser the past couple of years because the market goes up. What you see with the volatility index is basically the inverse of the stock market. So it's just one of these that goes down. It should go down. It's strictly a hedge on the stock market. So when the stock market's doing well, this thing is not going to go up. It's just like a slow deflation of a balloon. But then when the market turns, this thing moves really fast to the upside. So you can see just on Friday, it was up over 25%. And that's a massive move, and it's really gone up. It was at about, I think 2 weeks ago, it was around 10, like 10.5. And right now it's at 23. So we're talking more than 100% move in just a couple of weeks. And the thing is, if this is a bigger issue and it isn't just normal correction, this thing could get to 40 probably without any problem at all. Another interesting thing that kind of maybe tells me a little bit on the economy in general is gold's actually hit an all-time high yesterday. So while a lot of areas were struggling, the insurance policy, gold is an insurance policy from chaos. It acted exactly as you would expect it to do. And it went up a little bit. So that can be a little alarming. You think if this was just sort of a normal correction, an equities correction, gold would have come down as well. And then we have oil. Oil really took it on the chin. This could be a sign that we are, in fact, starting to slow down in the economy, because if the economy is growing, then certainly the price of oil is not going to drop quite like it has. I mean, it's gone from 84 a barrel to 73, I think it closed at 74. So yeah, from 84 to 74 in basically just a couple of weeks. That's a pretty big move. The one thing that kind of threw me off a little bit, usually when you have the entire world acting like there's a slowdown, a lot of capital runs to the dollar. The dollar index typically does well, but the US dollar puked it up yesterday. And that was a little surprising. I would think that if this is a legitimate downturn, if the markets around the world are expecting some sort of recession, we probably see the dollar start to rally as money runs to the US. So what was the big precipitator for yesterday's movement? And, it was basically the jobs number. I think they're finally starting to realize that things aren't as rosy as we're projecting. And interest rates are awfully high from the Fed right now, if we are in fact heading into recession. So this was the establishment survey. So again, this is the one that gets all the headlines in the press. And it came in at 114,000 jobs created, which it was way below the, I think, 175 they were expecting. But what's interesting too is this number, we've talked about this number was revised down considerably for the previous month. So the past few months, they've really, it's an election year, so they're going to fudge the numbers a little bit on the initial release. And then what they do is the next month, they go back and correct the previous 2 months and bring them down quite a bit. Well, so I think what freaked the market out is the market's figured out that, the initial jobs number report is being fudged because of an election year. So if they're fudging the numbers and they only came out with 114,000 of jobs, then it's clearly a number that's way worse than that. So that's what kind of freaked the market out, I think. This is a chart comparing the establishment survey. Again, the one that's used is mainly the headline that you see on CNBC and the major news outlets, compared to the household survey. And we have talked about this in the past. There's a little bit of a difference. The establishment survey tries to look at, things like new jobs. So they're looking for new W-4s that have been filed. They're looking for payroll service companies data. So they try to look at a lot of different things to give them an idea of what's going on, in the job market. Now, the household survey, all it does is it literally calls households. It surveys households and says, do you have a job? And is that yes or is that no? And the big difference there is the establishment survey. If somebody starts working 2 jobs, like if they get laid off from a full-time job and they work 2 part-time jobs, well, the establishment survey would say that they've created 2 new jobs. Whereas the household survey would stay the same and say, oh, okay, you had a job before and you still have a job now. They're not worried about, is it a part-time job? Do you have 2 part-time jobs? They're not looking at that. They're just looking at fully employed or employed households. Well, the household survey came back at only 67,000 jobs created. And we have talked about this in the past. There's been a really wide variance between the establishment and household surveys. So here the household surveys in red and establishments in green. Now, if you look back, this only goes through 2019, but even if you went beyond that, usually a pretty strong correlation between the establishment and household survey. I mean, since it's looking at job creation or job loss, you think that, yeah, over time, it should be pretty close. And while not perfectly correlated, because they are different methodologies, you can see for the most part, the chart is pretty spot on up until really about mid-2022. And right now, there's been a difference of about 3 million jobs between the household and establishment survey. So one of them's right and one of them's wrong, or maybe it's something in between the two. But clearly, the establishment survey has been really rosy and optimistic in what's going on compared to the household survey. So I think at some point this data is going to correct, and we'll see which survey is more accurate, or like I said, it could be maybe the midpoint between the two. Who knows? But definitely, I think the establishment survey has been way too rosy in its projections. And one reason, I think, one thing I've always pointed out with the establishment surveys, they have this thing they call the birth-death adjustment. And what they're trying to do is just to create a number of how many jobs have been, or how many small businesses have been created and how many small businesses have been destroyed over a period. And the thought behind that is, obviously, if you leave your W-2 job and you start your own business, you're still employed. And you're probably going to be employing other people if you start a small business. So they try to create this, adjustment, but it's always been an area where they've kind of really, again, fudged the numbers. And they'll have one quarter per year where they adjust the birth-death adjustment. But you can kind of see the past few years, it's been saying a lot of new businesses have been created. And certainly there have been. But if you look at this last month, it was saying that 246,000 jobs were created from this birth-death adjustment. And remember, we only had 145,000 jobs created overall. So if this number is off at all, then it's basically saying all the growth in the job market came from new businesses forming. I don't know about you, but in this condition with higher interest rates, a consumer that's really struggling here with inflation, I don't think this is a really keen environment for new business development. So I'm thinking that the past year, these numbers are probably seriously overinflated. And usually they'll probably in December do an adjustment for the whole past year. That's how they typically do it. And we'll see a lot of these jobs go away. But that will be, of course, after the election. And at that point, they can kind of come out with the actual data. So 145,000 jobs for the month, but 246,000 came from birth-death adjustments. We'll see. I'm not buying that completely. And the thing is, so why I think this might be a bigger thing, when you look at it, certainly it's starting to get a little tough here. The market freaked out at these employment numbers, but it also triggered something called the SAM rule. And Sam, I can't remember her first name, but she was an economist, and she developed, this algorithm that basically kind of said, looking at trends in employment, you can start to see when we've actually hit a recession. And the thing is, she didn't develop this until I think it was like 2010, but using, data from the past. And if you follow the rule that she's got here, it's basically been spot on for recessions dating back to the 1960s. And really what it's looking at is a trend of the 3-month moving average of the unemployment rate compared to the minimum of the 3-month averages from the past 12 months. So if you take the slowest 3-month average for the past year, and then when the current 3-month average rises a half a percentage point faster than that, that has basically told us that we're in recession. And these unemployment figures that came out this week basically threw us into the SAM rule. And this is just a chart showing you going back to 1953. I said the 60s is actually the 50s. So go back to 1953 to show you kind of when the SAM rule broke and how far into a recession we were. And what you notice from it is once that SAM rule has been violated, it basically means we're already in a recession, anywhere from 1 month to 8 months based on the data from the past. So if this is true, I think maybe this is what really threw the market for a loop. Is it if we're hitting this figure, it's saying we're already in recession. Now, is that recession just freshly minted and it's only been around for a month? Or have we been in recession here for a few months? But we'll see. Nobody knows for sure. And then the other factor that kind of makes me think that this could be something a little bit bigger, and I've talked about this endlessly, it's the yield curve. So we've been looking at the yield curve. Anytime we've gotten a deep yield curve inversion like we've had, every single time it's been correlated with a recession. And the longer and deeper the inversion, the more painful the correction is. Now, we look at a lot of different things to see about the inversion. And right now, the 10-year and 2-year, it's not quite inverted. I think it's like 0.4% away from being erasing the inversion. So, but it's been steepening quite a bit here for the past few months, and we're starting to get to the point where it's probably going to uninvert very soon. And we talked about this last time. Now we've already got it where the 2-year and longer dated are already back to a normal upward sloping curve. So this gives you the 1 month all the way up to the 30-year. But we talked about, I think it was a month ago, where the 2-year and the 30-year had just steepened, meaning that the 2-year was once again yielding less than the 30-year. And that just happened about a month ago. But look at the yields now between the 2-year and 30-year. So when we talked about this last time, the 2-year Treasury had just kind of broken the 4.1% rate. And even in a month now, it's now down to 3.882. That's a big move in treasuries. That's a very big move. And you can see we're awfully close. Oh, so I guess the 2-year and 10-year, I'm sorry, this chart is from yesterday. It wasn't 0.4%. We're literally about to see that thing steepen and uninvert. So, I mean, we're talking really less than 0.1% now. So it's awfully close to hitting the factor. And why is it important when things uninvert? So the inversion tells you something's wrong, but when it finally uninverts, or what we call a steepening, that means that that's where usually the recession hits. Normally it happens because the Fed starts to drop rates. They're panicking. And so when the shorter term moves faster than the longer term to the downside, that's usually a pretty ugly scene. It's called a bull steepening. And we talked about this last time, and that's what we're seeing right now. So the fact that we're starting to see the employment figures kind of at least alert us to the fact that there might be a recession, and then the Treasury market's doing the same, those are two big factors. And I've talked about this a lot. I always say it. You look at stocks. Stocks are the bond market's little brother. And the bond market tells the story. The bond market's the smart money. So you could have the bond market doing one thing and stocks could do something completely different. But then eventually stocks will figure out what the bond market's saying and they'll act accordingly. And so the fact that we have unemployment or employment plus the bond market both kind of giving us some nasty signs here. Maybe that's why the stock market really started to show some fear here. But you can kind of see this is the 3-month T-bill. So the Treasury market's expecting the Fed to cut rates. The Fed came out this week, said, yeah, well, we've got a rate cut on the table for our September meeting. And right now, at least the Treasury market is saying, hey, the Fed's got to move sooner than that because the Fed's fund rate is still at 5.5. So we'll know if the Fed starts to panic. If the Federal Reserve cuts rates before their September meeting, which is a month away, then we know that they're panicking and they're really seeing some bad stuff. And in fact, I think a lot of people think that they should do it, and maybe they should start now. But if they do it before their September meeting, I think it's going to have the opposite effect. It's going to show that they're scared, and it's going to cause more panic in the markets because it's basically confirming that they see what the bond market sees. But this is a really big move down in a 3-month T-bill. 3-month T-bills shouldn't be moving anything like they are right now. So that's a huge move. And here's the 1 year. Again, the same thing. So when you see moves this big, this fast, it's usually it could be a panic. I mean, this could turn around, but a lot of times it's finally like a confirmation move by the markets. Here's the 2 year. So you can see, I mean, just in June, we were close to 5% on the 2 year Treasury. So if you bought a Treasury just a couple months ago, a 2 year Treasury, good for you. You got 5% here for the next couple of years. And clearly the market has moved this thing down precipitously to 3.8%. The 10 year has also, it's moved down a lot in a short period. This is a big move for the 10 year as well. 10 year Treasury can be a little bit more volatile than the 2 year or 1 year or 3 month, but so it's a pretty sizable move. We saw something like this a little bit at the end of last year, but really to see it hit here, that's impressive. And I mean, even a 30 year, just 2 weeks ago, you could have got 4.6% on the 30 year. Now it's at 4.1. That's a pretty sizable move. But again, it's also an awfully big steepening here between the 2 year and the 30 year. So 3.88 and now 4.109. So when we talked last month about this, the 2 year and 30 year had just steepened or had just uninverted. Now it's a pretty sizable, almost a 25 basis point, 0.25% in steepening. So that's pretty well uninverted at this point. And just another little thing, you really can't judge what's going on by what corporate insiders are doing, but they're selling, hand over fist. And when you see this, it could just mean that they thought maybe their stocks are due for a pullback. Maybe it's a little overvalued and they're taking advantage of it. But this is a pretty big number here of people that are dumping. So it's definitely something to look at. They're not buying much of their stocks and they're dumping quite a bit. Doesn't mean that necessarily this has anything to do with being a recession or not, but it does kind of let you know, at least on the stock market, maybe some overvaluations. But the thing is, so, how am I going to act on this? I've been adding value stocks, and value stocks have done nothing. I mean, I've avoided the tech stocks this year in your portfolios. Certainly hasn't worked out for the most of the year, but right now it looks pretty good. But looking at some other little companies that tend to do very well in market turmoil. And this one, some people don't like this one. It's Altria. So we're talking cigarettes. A lot of people don't like it, but I tell you, the thing about it, it's rock bottom cheap and it drives a ton of cash flow. And that's what we said at the outset of this presentation. Cash flow is what you're buying when you invest in a company. So this thing has a price to earnings less than 10. It's really cheap, even less than 9. Whereas, I told you NVIDIA was at 100 times earnings, actually 120 times earnings at one point. So what that's saying is, if the earnings stayed the same, it would take you 120 years to get your money back from NVIDIA, whereas with Altria, it would take you 9 years. Now, the earnings are growing for both companies, and they're growing much faster for NVIDIA. So you have to take that into account. But still, it gives you a good idea of what you're paying today for future earnings. The other thing about Altria is it's kicking off 7% dividend yield. So even if it just sits there and the price doesn't do anything at all, you're going to just sit back and kick in 7%. And what we've seen here the past, if I showed you a chart for the past 5 years, Altria has been between 45 and 40 pretty much the whole time. But really in the past month, it started to move up, and it's done quite well this past month. Another boring company, but it's starting to move to the upside is AT&T. Again, low price to earnings, just over 11, and close to a 6% dividend yield. So it's a very mature company. It's not sexy, but it's cheap and it pays you. So these companies tend to do pretty well. The consumer staples they were actually up yesterday. So, and the other thing that we do have right now, utilities were down, but they were only down like 0.4%. So utilities is going to be a sector you want to be in, which we already are. And we'll just add some more really low cost consumer staples that are paying nice dividends. That's one area you can go for equities. The other thing is looking at adding a little bit more to some longer dated bonds. If in fact this trend holds, I'll probably wait a couple of days just to see. When you have a move this fast in both stocks and bonds, I'd expect a little bit of reversal. So next week, I would think stocks would do pretty good, and bonds will probably pull back a little bit. Nothing keeps going in the same pace like this when it moves as it does, but probably start to think about next Friday, adding some longer date treasuries if this long-term trend remains in place. So we've got a lot in T-bills the T-bills we have are still, 5.2 to 5.4%. So that's good. But what you can do by going out into the 10-year and even the 20-year TLT is you can actually start to get capital appreciation. So not only are you going to get the yield from those bonds, but you're also going to get appreciation. And I've given this example before. Bonds are always a tricky thing for investors because when it gets reported on the financial news, they report it as bond prices. Sometimes they'll say bonds are down today, but that also they could report it as yields. And they say yields are up today. So you think, well, is that good or bad? Like people are always confused. So you have to think of it the opposite way of the stock market. So when bonds are going down in value, that means the yields are going up. And when yields are going down, that means the bond price itself goes up. And to give you an example of why, longer dated treasuries might be a good place to be if this trend is in fact signaling something more nefarious in the economy. So let's say, just a few months ago, you bought a 10-year treasury at 5%. And literally it was just a few months ago. You could have done this. In fact, like 2.5 months ago. So let's say you put $100,000 invested into the 10-year treasury. So basically for the next 10 years, you're going to get $5,000 a year. And then at the end of the 10 years, you get your money back. So you're kind of happy with that. But then the market moves and yields come down. So a new investor today could put $100,000 into a 10-year treasury at 4%. So if you invest today, you're only going to get $4,000 of interest per year. So, if you wanted to sell your bond, if current interest rates are 4%, but you have one at 5%, well, you're obviously not going to just sell your bond for $100,000. That would be foolish because you're getting more yield than a current investor would get today. So basically, the price of the bond, the $100,000 you invested, is then adjusted so that if somebody bought your bond, they would get a 4% interest rate. So, you don't want, the investor isn't going to get a freebie here. So if they could just go out and buy a brand new treasury, put 100,000 in and get 4% of that. Well, if they buy a treasury that has existed before with a higher 5% interest rate, well, then they're going to have to pay more for that bond because they're only going to get $4,000 of interest. So if you were to say, well, okay, well, bond rates have dropped, I'm going to sell my 10-year treasury. So you sell your bond, and what you would end up getting is $125,000 on your initial $100,000 invested. And the reason is because at 4%, $125,000 will yield $4,000 of interest, which is what an investor would get today if they just invested straight into a new bond. And this works the other way too. So if you flip this the other way, if you bought a bond at 4% and now yields are at 5% and you wanted to sell your bond, you're going to have to take a haircut on your $100,000 invested in order to give somebody that $5,000 of interest or the 5%. Nobody's going to buy your bond at 4% and give you the full $100,000 face value. So you would have to sell your bond for $80,000. So you can see bonds do have capital appreciation or depreciation if the bond yields work against you. So that's why bonds going out longer term, even if the current interest rate is a little bit lower than what we're getting in T-bills right now, starting to add some of that to longer dated stuff could be good if the bonds continue to appreciate. Okay, so I always finish off with our disclaimer. If you want to read that thing, you can watch the replay, press pause, and take it all in. Okay. So yeah, we'll see. Is this actually the start of the recession I've been thinking is going to hit, and it hasn't? I mean, I've been wrong. It's definitely, I was thinking by now, I thought by now we'd be into a recession. But it just hasn't happened. But the thing is, now we have two really big cues, maybe saying it happened. So we're starting to see the numbers in the employment figures. When they've hit these levels, it's always been a recession. And then, of course, the bond curve uninverting has always been kind of the telltale. And we're getting both of those at the same time. Okay. What's your outlook for oil with the Iran-Israel conflict as it continues to escalate? Really good question. I mean, at the end of the day, it's going to have a big impact on oil. So oil could absolutely, we could see sort of recession happen and oil go up. If you've been around since 1973, when we had the first oil embargo, essentially that was our punishment. So the OPEC countries cut their production radically because they were upset we were helping Israel in the Yom Kippur war. So they just said, hey, we don't like what you're doing, and here's what we're going to do to you. So you could see something very similar. So far, OPEC hasn't penalized the U.S. or the rest of the world for what's going on in Palestine, but they haven't been happy about it. Now, OPEC did cut back 1 million barrels a year, but they were doing that really even before the whole, October 7th thing took off. They'd already announced that they were doing that to keep the price of oil up. But if this happens, I mean, clearly you're going to have some oil taken off just with Iran itself. But, if we get involved in this and we come to the aid of Israel, And I'm not saying we should or shouldn't. But if we do, the consequence of that could be that OPEC then decides that they're going to hit us like they did back then. And, the other thing going on with Venezuela too, so that factors into it because we basically, Biden administration made a deal with Venezuela. We've been taking in their oil. We reduced the sanctions from Trump, and in exchange, Venezuela said they would have free and fair elections if we did that. And clearly we haven't gotten that. So I don't know what's going to happen there. There's clearly conflict, which will probably affect that supply. Or is the U.S. going to, punish Venezuela and Maduro and maybe put the sanctions back on? So you could have a couple things going on with oil that go even beyond just the normal supply and demand of the economy in general. So we could be in a recession, which would normally be a decline in oil and oil prices, but we could see the price of oil go up because of external conflicts. So good question. I don't know what will happen, but I would suspect that prices would go up if this thing escalates. And then if the rest of the OPEC countries want to punish us, they could go up quite a bit. Okay, good question here. I've seen data that full-time jobs have been net loss for the past 2+ years. New job creation has been part-time jobs and jobs numbers from the BLS counts. All jobs, not people holding multiple part-time. It slows the failing economy. Okay. Also, data shows most job creation for the last 3 years has been among the illegal aliens. Yeah. A lot of that could be absolutely true on the new jobs being illegal aliens. But you're absolutely right. Part-time jobs have gone up considerably the past couple of years, and full-time jobs have been declining. So that's why I think that household survey and establishment survey, there's a difference there. Because if you had a full-time job, more than likely you're probably going to have to take 2 part-time jobs in order to get the same kind of income that you would have gotten with your full-time job. So the establishment survey, that's 2 jobs. Household survey, that's just 1 job. So I think that's what leads to the difference between those two. We'll find out more. But as far as the jobs for citizens versus non-citizens, it doesn't. The surveys don't care about that. They're just looking at what jobs have been created and what have been, basically let go. So it could be. I mean, these could all be lower paying if they are part-time job. Part-time jobs are typically lower paying. One chart I probably should have shown you, I've shown you in the past, temporary jobs have been dropping like a rock. So if you have a company, and I've done this for my own company for admin positions, if I needed more admin help, I would hire a temp agency who would send me somebody and they'd work with me for a couple months. With the tax office, I would do that. And the first one to get cut would be temp jobs because they're not actually even employees of the company. You just stop hiring the temps. And those have been dropping for about a year now, considerably. So that's usually the first shoe to drop in the employment index. And that's been going down. So we'll see. I don't know, maybe this is all just noise and we're just having a minor correction and we're heading up. But, both the bond market and employment figures are kind of saying the same thing. And then you throw in, little ancillary data like corporate insiders are dumping. That's a sign. Rob says, you'll know it's bad when Pelosi's dumping stocks. She might be. They don't have to disclose as often as corporate insiders. So, and then so Steve says he's owned AT&T for years. Yeah. So I mean, it hasn't been a sexy stock at all past few years. Great dividends, so great cash flow. And those are just the kind of companies that tend to do pretty well if we are in fact heading into some rougher waters for the stock market. That's basically it. Okay. Well, I think that's all I've got for this week. And again, if you have questions, please let me know. I was going to talk about bonds and dig deeper into bonds. I had a client talk about why would you invest in TLT, and I didn't get fully through that, but mostly because I got a lot of emails yesterday when the market was puking its guts out. So yeah, we'll continue to look at that, and I think in 2 weeks from now, when we do our next one, we'll probably know a little bit more which way this thing's heading. If bond yields continue to go down, and if the Fed steps in and sort of panic drops rates, then we'll know things are probably pretty bad. But we'll see. Could turn around. Anyway, hope you guys have a fantastic weekend, and we'll talk to you soon. Take care, everybody.